Imagine waking up one day and realizing that half or even more of your investments have vanished overnight. The news calls it a market correction, but in reality, investment, you've been caught in the largest financial bubble in history. This isn't just about numbers or stock charts. It's about human emotions, greed, and fear running wild. Today, we'll uncover how this historic bubble formed, why it eventually burst, and the lessons that can protect you from losing everything. Financial bubbles never just appear out of nowhere. They are carefully built over time by a mix of excitement, accessibility, and often pure human psychology. At the very start, there's usually a spark, a new technology, a new market, or a new financial product that promises extraordinary returns. People hear stories of neighbors, colleagues, or even complete strangers making huge sums of money seemingly overnight. That's when curiosity turns into action, and action turns into speculation. At first, only a few people jump in cautiously, testing the waters, investment. But as more and more notice the potential gains, the participation grows. Soon, it's no longer just an investment opportunity. It becomes a cultural phenomenon, a trend that everyone feels they must join or risk missing out. One of the most fascinating aspects of bubbles is that the initial gains often seem completely rational. Early investors might genuinely see value, and their profits look like a reward for insight and strategy. But as the bubble inflates, prices begin to diverge sharply from any real or intrinsic value. Stocks, real estate, or whatever asset is involved start moving based on sentiment rather than fundamentals. People are no longer evaluating whether an asset is worth its price. They are asking only, will someone pay more than me tomorrow? This shift marks the first stage of the bubble, the transition from rational investing to speculation driven by emotion and social proof. Financial institutions often play a crucial role in fueling the growth of a bubble. Banks and lenders, seeing enormous profit potential, make borrowing easy and cheap. Investment credit flows freely to anyone willing to buy into the hype. Investment products that seem complex and sophisticated appear everywhere, offering the illusion of safety and the promise of high returns. The combination of easy credit and mass participation creates a feedback loop. Higher demand pushes prices higher. Higher prices attract more people, and the cycle repeats. In the largest bubbles in history, this feedback loop became almost unstoppable, with each new wave of investors feeling pressure not to miss out, while seeing others become instant millionaires. Investment. Another key factor in the formation of bubbles is the media and social reinforcement. Every story about someone striking it rich, every news article praising booming markets, every casual conversation about the next big thing reinforces the perception that investing is not only profitable, but necessary. As more people buy into the idea, skepticism fades. Doubts are dismissed as outdated thinking or fear of missing out. Rational voices warning about overvaluation are ignored, laughed at, or even ridiculed. And this social momentum is critical because bubbles are not just financial. They are psychological and cultural phenomena. The human brain is wired to respond to patterns and stories, investment, which explains why bubbles can grow so large. Early successes feel like proof of skill, and even when markets start showing signs of instability, people often convince themselves that they are somehow different, that this time is different. The fear of regret, seeing others make massive gains while you sit on the sidelines, overrides caution. This creates an environment where the bubble can expand far beyond what any rational analysis would support. In addition to human behavior, leverage is a silent but powerful force behind bubble growth. Investors using borrowed money can buy more assets than they could otherwise afford, magnifying both potential gains and potential losses. When everyone is using leverage, the market becomes extraordinarily sensitive. Even small shifts in sentiment or minor changes in interest rates can have an outsized impact on prices. In the largest financial bubbles, this leverage created an unstable foundation, like building a skyscraper on sand. It looks impressive, but it won't withstand any significant stress. The scale of such bubbles also demonstrates how interlinked the economy becomes during these periods. Markets, banks, businesses, and even ordinary consumers start to participate in the speculative frenzy. Wealth seems to grow everywhere, creating a false sense of security and normalcy. People take on more risk, assuming the upward trend will continue indefinitely. But underneath this surface, vulnerabilities accumulate, debt levels rise, valuations become unrealistic, and confidence rests on perception rather than substance. That's understanding how bubbles form is not just an academic exercise. It is essential for anyone who wants to protect themselves financially. Recognizing the signs, the combination of hype, easy credit, social reinforcement, and extreme price increases can help you make smarter decisions. While it's tempting to chase the excitement and potential profits, knowing that bubbles are driven by psychology and momentum allows you to step back and evaluate risks. By understanding the anatomy of a bubble, you give yourself the opportunity to act rationally while others are swept up in the euphoria. And that is often the difference between financial security and disaster. The most fascinating part of any financial bubble isn't the numbers, charts, or economic indicators. It's human psychology. At the heart of every bubble, you'll find the same emotional drivers, greed and fear. Greed pushes people to chase profits beyond reason, while fear ensures that when the bubble collapses, the crash is sudden, widespread, and devastating. During the largest financial bubble in history, these emotions didn't just influence a few investors, they dominated entire markets, turning rational decision-making into chaos. Greed is the engine that drives a bubble upward. Imagine seeing a neighbor, coworker, or friend double their money in a matter of months. The natural human response isn't to step back and analyze the risks. It's to ask, why am I missing out? That simple question sets off a chain reaction. People start investing without understanding the fundamentals of the asset or market. They ignore warnings, believing that the upward trend will continue indefinitely. The more people see others succeed, the stronger the belief becomes that it is safe, smart, and even necessary to participate. This herd mentality amplifies the bubble because everyone is now buying for the same reason, because everyone else is buying. During the largest bubble in history, stories of overnight wealth circulated like wildfire. Media headlines glorified success and downplayed risks. Every narrative reinforced the belief that this was a once-in-a-lifetime opportunity. When people see such extraordinary gains around them, rational caution becomes almost irrelevant. Behavioral psychology shows that humans are wired to respond to social proof. We mimic what others are doing, assuming that if everyone else is profiting, we will too. That assumption, however, ignores the realities of valuation, debt, and economic fundamentals. Fear is the other side of the coin, and it is just as powerful. As the bubble grows, even a small signal of trouble, a missed earnings report, a policy change, or a dip in the market can trigger panic. Once fear sets in, it spreads faster than greed ever did. Investors realizing that prices are inflated and confidence is fragile rush to sell. Those who used leverage or borrowed heavily to invest are forced to liquidate positions, further accelerating the collapse. What was a slow climb driven by optimism suddenly becomes a plummet fueled by panic. The emotional roller coaster is extreme euphoria turns into anxiety, and anxiety quickly turns into despair. One of the most striking lessons from history is how easily rational warnings are ignored. Investment. During the largest financial bubble, there were experts and analysts pointing out overvaluation, risky practices, and warning signs of instability. Yet most people dismiss these warnings as overly cautious or even alarmist. The fear of missing out, the powerful psychological drive known as FOMO, was stronger than any careful analysis. Investors convinced themselves that the rules of the past no longer applied, that this time the market was fundamentally different. This is a classic hallmark of bubbles, the illusion that logic and history no longer matter. Herd behavior also plays a critical role. People don't make decisions in isolation. They watch what others do and assume that collective wisdom is more reliable than their own judgment. In the largest bubble, when early investors profited, the rest of the population rushed in, not necessarily because they understood the market, but because they assumed everyone else's decisions were correct. This self-reinforcing cycle can push asset prices to irrational levels, sometimes hundreds of % above intrinsic value. It is both fascinating and terrifying how quickly human behavior can inflate a market beyond what any rational analysis would support. Another psychological factor is overconfidence. As people see their portfolios grow, they begin to believe in their own investing skill rather than the luck or timing that may have contributed to their gains. This overconfidence makes them take even greater risks, reinforcing the bubble further. When the inevitable downturn comes, these same investors are often the hardest hit because they were convinced they were immune to the market's volatility. Understanding greed and fear is not just theoretical. It has practical implications for protecting yourself. Recognizing when emotion is driving your decisions allows you to step back, assess risk objectively, and make rational choices. It helps you avoid the common trap of buying assets simply because everyone else is doing it, or selling in panic when a temporary dip occurs. By observing the psychology behind bubbles investment, you gain a clearer perspective and a stronger ability to preserve your wealth when markets swing wildly. The largest financial bubble in history serves as a stark reminder. Markets are not only numbers, they are human behavior in action. Greed inflates prices, fear triggers crashes, and both operate far more powerfully than logic. Investment. Those who understand these emotional dynamics are not immune to mistakes, but they are far better positioned to avoid catastrophic losses. In investing, as in life, recognizing the forces driving decisions is the first step toward mastering them. Every financial bubble eventually reaches a tipping point, the moment when exponential growth turns into a sudden, devastating collapse. Investment. While greed and speculation inflate asset prices, it is always a trigger that flips the market from boom to bust. Understanding these triggers is critical because they reveal how fragile even the most seemingly unstoppable market can be. In the largest financial bubble in history, the tipping point was not a single dramatic event, but rather a combination of small shifts in confidence, regulatory changes, and economic signals that together caused the market to unravel at lightning speed. At the heart of the collapse is a sudden loss of confidence. Markets rely on trust, and during bubbles, that trust is often superficial. Investors assume that prices will always rise. Investment. But the moment doubt enters the market, everything changes. When even a few participants start selling, others notice and begin to question whether the frenzy has gone too far. Panic spreads faster than any rational analysis could predict. People rush to sell before prices drop further, creating a domino effect that accelerates the collapse. What was a gradual climb fueled by optimism becomes a free fall driven by fear. Leverage plays a particularly dangerous role in this stage. Many investors, emboldened by rising prices, borrow money to increase their exposure. In a bubble, this strategy works brilliantly until it doesn't. The moment asset prices start to decline, leverage positions magnify losses. Investment. Investors are forced to sell assets at depressed prices to cover their debts, further driving down market value. In history's largest bubble, leverage acted like gasoline on a fire, turning an already precarious situation into a full-blown financial disaster. Those who had borrowed heavily were often wiped out completely, while those who remained cautious survived relatively unscathed. Investment. Triggers that collapse a bubble are often subtle at first. It could be a slight increase in interest rates, signaling that borrowing will become more expensive. It could be a minor regulatory change that shifts investor sentiment, or it could be an unexpected economic shock, a company going bankrupt, a sudden drop in housing prices, or a geopolitical event. And each of these small signals alone might seem insignificant, but in a market built on speculation and hype, they are enough to spark a chain reaction. Once confidence is shaken, selling accelerates, prices fall, investment, and panic sets in. The larger the bubble, the more sensitive the market is to these triggers. One of the most striking aspects of the largest financial bubble is how quickly fortunes disappeared. People who had seen their portfolios grow exponentially over months or years watched in horror as values evaporated almost overnight. This rapid collapse is not just a financial phenomenon, it is an emotional one. Investors experience a roller coaster of euphoria, anxiety, and despair. Those who were once confident in their decisions are suddenly paralyzed by fear, unsure whether to sell, hold, or buy more. The psychological impact of witnessing a bubble burst is as profound as the financial one. Another factor that accelerates the tipping point is herd behavior. Just as greed fueled the bubble's growth, fear magnifies its collapse. When one investor sells, others follow. When institutional investors begin liquidating large positions, smaller investors panic and sell as well. This cascading effect transforms what might have been a controlled correction into a full-scale market crash. During history's largest bubble, this dynamic created extreme volatility, wiping out trillions of dollars in value and leaving countless people financially and emotionally devastated. Yet, even in these chaotic moments, there are lessons to be learned. The tipping point demonstrates the importance of preparation, diversification, and risk management. Investors who maintained a long-term perspective, avoided excessive leverage, investment, and focused on assets with intrinsic value were far better equipped to weather the storm. Those who understood the warning signs and acted early were able to preserve wealth, while those who ignored signals suffered the consequences. Studying the triggers that turn bubbles into crashes gives us insight into how to protect ourselves and even capitalize on opportunities when others panic. Ultimately, the story of the largest financial bubble shows that no market is invincible. Growth fueled by speculation and emotion can only continue for so long. Small shifts in sentiment, leverage, or policy can have outsized effects. By analyzing these tipping points, investors can make smarter, more informed decisions. Recognizing the fragility of a bubble and the triggers that can collapse it allows you to prepare, protect your assets, and stay rational when everyone else is swept up in panic. History may repeat itself, but the consequent events don't have to catch you by surprise. The final lesson from history's largest financial bubble is that understanding past mistakes is the key to making smarter decisions today. While bubbles are inevitable, losing everything in them is not. The critical factor is preparation. Knowing how to navigate markets, control emotions, and make disciplined choices even when the crowd is caught in hysteria. Many investors view bubbles as purely destructive, but in reality, they also offer lessons and opportunities for those who are alert, patient, investment, and rational. First, it's essential to never invest more than you can afford to lose. During bubbles, greed can convince even experienced investors to take on enormous risk. The promise of huge returns overshadows rational thinking. History shows that those who risk too much, leveraging their assets, ignoring fundamentals, or putting all their money into a single speculative market were wiped out when the bubble burst. On the other hand, investors who limited exposure and maintained a margin of safety survived and even thrived. By acknowledging that losses are possible, you make room for measured decisions that protect your financial future. Second, focus on intrinsic value rather than hype. Everything makes a good investment. Bubbles inflate prices well beyond what assets are truly worth. When everyone is buying because they believe someone else will pay more tomorrow, the underlying value is often ignored. Smart investors look for assets backed by real earnings, cash flow, or tangible resources. They don't chase trends blindly. This approach doesn't mean avoiding opportunity. It means entering markets with knowledge, discipline, and the confidence that your decisions are based on facts, not fear or speculation. In the largest financial bubble, those who adhered to fundamentals may have missed some of the skyrocketing gains, investment, but they avoided catastrophic losses when the collapse occurred. Third, emotional discipline is critical. Greed and fear drive bubbles and crashes, but they are not your friends. Keeping emotions separate from investing allows you to think clearly when the market swings wildly. During bubbles, panic selling and euphoric buying are common mistakes. Those who remain calm, follow a strategy, investment, and resist herd mentality are better positioned to make rational choices. Emotional control doesn't just preserve wealth, it creates opportunities. When others are selling in fear, disciplined investors can buy high-quality assets at discounted prices. When others are euphoric, these same investors can take profits without regret. Fourth, always take a long-term perspective. And bubbles are short-term phenomena, but financial growth is achieved over years or decades. History's largest bubble demonstrates how quickly markets can turn, but it also shows that recovery is possible for patient, informed investors. By focusing on long-term goals rather than short-term gains, you reduce the impact of temporary market volatility. Diversifying across asset classes, geographies, and strategies ensures that you are not entirely exposed to any one bubble or crash. Long-term thinking transforms potential disasters into manageable challenges and positions you for steady wealth accumulation over time. Fifth, learning from history is non-negotiable. Every bubble, whether it's Tulip Mania, the South Sea bubble, or the 2008 financial crisis, follows similar patterns: hype, speculation, leverage, and eventual collapse. By studying these patterns, investors gain foresight. You learn to spot early warning signs, understand the emotional forces at play, and recognize when a market has become dangerously overvalued. Knowledge empowers you to act before panic sets in and to preserve your assets even in the face of widespread irrational behavior. Finally, bubbles also present opportunity. While most people focus on losses, those who prepare can profit from the chaos. Shorting overvalued assets, diversifying into safer investments, or buying quality assets at discounted prices after the crash are strategies that turn historical lessons into practical advantages. The key is preparation, discipline, clear understanding of both the risks and rewards. Opportunity often appears when others are blinded by greed or fear, and history proves that careful, rational investors can benefit immensely while others suffer. Investment. In the end, the story of history's largest financial bubble is a lesson in human behavior, market dynamics, and personal discipline. Greed and fear may drive bubbles, but knowledge, preparation, And rational action can protect you and even allow you to thrive. By investing with awareness, focusing on intrinsic value, controlling emotions, thinking long term, and learning from history, you can navigate markets safely and confidently. The bubble may burst, but your strategy doesn't have to. The ultimate takeaway is clear: the market's volatility is inevitable. Investment, but your response determines whether you survive or thrive.